has been mounting on the country's foreign reserves despite the increase in crude oil prices. Now, over the past 3 decades, Nigeria has implemented numerous policy initiatives and measures in the management of its external reserves, although very little has been achieved because the structure in place could not support sustainable external reserves management. According to the most recent data from the Central Bank of Nigeria, the country's external reserves maintained a downward trend as it lost $905.5 million in June, witnessing a holistic depletion. The data also shows that the reserves fell to $33.32 billion as of the end of June 30 from $34.23 billion on May 31st, 2021. Despite the significant impact of the COVID-19 pandemic on the global economy, foreign direct investment inflow to the country also increased to $2.4 billion in 2020 from $2.3 billion in 2019, making the country the highest recipient of the FDIs in the West African region. Going by the persistent decline in Nigeria's external reserves, financial experts have expressed the need for government to attract more foreign direct investments into the country and stimulate domestic production to attract more foreign exchange and reduce the demand on forex for importation. Investment research analyst at United Capital PLC, Mr. Ayorinde Akinloye, joins me now via Skype to continue this discussion. Mr. Ayo, it's good to have you on the show. Good afternoon.
Thank you for having me, Tolu. It's always a pleasure to be on the show. Thank you.
Yeah, yes, generally we've all seen quite a pendulum swing with the nation's foreign reserves. The drop in volume is a major concern despite the oil price rally, like I said in my introduction, where we recorded $905.5 million just last month. Now, what do you make of this? It's a 2-in-1 question, and without a change in the narrative away from the current subsidy regime, do you think we would have a bounce back soon?
Okay, I think first it's important to look at what has caused the depletion that we've seen in external reserves basically over the past few months. So if you look at between May and June, the external reserves has lost about $1.8 billion. In May it lost almost 2%. In June it lost about 2.6% in June alone. And even in July, the first about 8 days of July, the external reserves has gone down by almost 1% already in July. So the question is, why is external reserves? Why is the gross external reserve going lower, despite the fact that oil prices have been improving? Well, you look at CBN's activities in the I&E window, right? Between January and April, average intervention of the CBN in the I&E window was below 10%, about 9.4% between January and April. But if you look at the average intervention of CBN in the I&E window between May and June, you will notice a significant spike. So from about 9% of total inflows in the I&E window, it jumped to about 34% in May and June. So you can see the significant spike in, how much CBN was intervening in the I&E window, where is the major FX market, for Nigeria, basically. And also, you also look at the fact that when you compare the activity levels, right, in terms of inflows, FX inflows into the I&E window, in terms of the total turnover, the activity level within the I&E window, total transactions done between June and April, between January and April, it averaged about $64 million. But by the time you get to May and June, it's averaging about $140 million. So that's more than double, and it coincides with the period where CBN's external reserves, where external reserves have been declining significantly. So largely you can point to the fact that CBN has been actively intervening in the FX market in May and June. That's the main factor that has affected external reserves. So as much as oil prices have been improving and FX inflows may have been coming in, but the fact that CBN has been actively intervening in the market has meant that the impact on external reserve is basically a net outflow. Now, considering also the fact that we are still importing a lot of PMS also, in terms of when you look at the fact that crude oil prices have been rising, like you mentioned, with the subsidy regime still in place, it means we are spending, significantly more. We are spending more on PMS importation into the country also. So these are key factors too that we need to watch out for. So do we think that we'll see an improvement in the next maybe 2-3 months or before the end of the year? Yes, definitely. We think there will be an improvement for in external reserves before the end of the year, and that's largely because the federal government would most likely issue an euro bond before the end of the year. And according to media reports, there are reports that the approval would soon be granted by the National Assembly in the coming weeks for Nigeria to raise about 2.3 trillion, which in dollar terms is about $6 billion. So if we are able to successfully issue external debt worth $6 billion, either via Eurobonds alone or a combination of Eurobonds and multilateral loans from the likes of World Bank and IMF, when these inflows come in, they will definitely help bolster external reserves before the end of the year. So definitely we can expect to see an improvement on that front.
So Ayo, actually, you got me there, because that was my next question. The biggest caution raised by analysts is the hope that it doesn't go back to the $30 billion threshold. Of course, that seems to be extreme, but you've talked about the forecast. Do you think we could get to this point? Can it get this bad before we begin to stabilize?
Well, definitely, we don't expect it to get that bad. Currently, total gross reserves is at about $33.1 billion as at 6th of January. Yeah, so we're about $33.1 billion. So for us to get to $30 billion, that means $3.1 billion needs to go out of the reserves. And looking at the run rates between May and June at the level in which CBN has been intervening in the FX market, it means we will need to have another 3 months similar to what we've had in May and June. Basically, we need to have another 3 or 4 months of that for external reserves to get to $30 billion. And we don't think that we would have that. We think, anytime within that period the next 3 to 4 months, we should have inflows from the Eurobond issuance actually come into the country. So we don't expect external reserves to decline significantly to $30 billion before we begin to see a rebound. Now, also one thing that we would also mention is the fact that one of the reasons why CBN is intervening significantly is because it's part of an attempt to try to clear some of the FX backlog that they've had since 2020 and even down into the first quarter of the year. So basically, they've been trying to clear some of the backlog to sort of restore confidence for foreign investors, that their FX demands would be met. But we think that once they are able to at least clear the FX backlogs to a decent level, and they are also able to maintain a decent level of intervention in the retail markets and other segments of the market, basically, we think that the CBN will be absolutely comfortable with that. So maximum maybe in another few, say 6 to 8 weeks, we should see very, very decent stability in the FX reserves. But we will definitely not get to that precarious level of 30. We most likely will not get to that precarious level of $30 billion.
Let's now look at this other source of Forex or FX generation that's talking about the agenda of diversification and expanding the inflow base from exports of agri products and even minerals. It seems very simple if we look at it, but why is it so difficult for government to expand the product base to support more inflows and, of course, help shore up reserves?
Okay, clearly, I think basically we are speaking to FX inflows via foreign direct investments into Nigeria. One thing we have to highlight is the fact that to improve most of these key sources that you mentioned, for example, agriculture and mining, basically for minerals, they will take significant long-term investments, in terms of huge capital outlay for us to be able to harness the potentials of those sectors, right? And we know the fact that the federal government does not have the capacity, does not have the fiscal or the financial power to be able to make all the necessary capital investments needed to get those sectors to be very active, right? So the we definitely need to rely either on the private sector providing the finance, or rely on foreign investors who can afford to make such investments within those sectors. But the question now is, would investors be attracted to invest in those sectors? Why would the foreign investor in the US or in the UK or even in China or another country, would they want to come into Nigeria to invest long-term capital in an economy that has demonstrated significant levels of instability, over the past 6-7 years? You look at the FX situation, you look at the fact that the infrastructure framework of the country is still very much, archaic, and little or no investments have been done, relative to the amount of investments required to galvanize investments, in terms of infrastructure. Little or no amount has been really invested in that, in alleviating the infrastructure pressure facing the country. So as an investor, those are the factors you look at, before you think of bringing in your capital into the country. So we think there's still a lot of efforts that needs to be done by the federal government. It's not necessarily on the part of providing the finance, because clearly they don't have the fiscal capacity to do that. I mean, we saw the January to May fiscal performance for the federal government, and about 19% of the revenues that they make, is spent on servicing debts, basically. So they definitely don't have the money that is needed to do that. But from a policy point of view, we think the federal government, has a significant role to play in order to improve business sentiment and attract that, foreign capital that we need to revive those sectors, which will be a two-way thing, right? When the capital is coming in from these foreign investors, they are long-term capital that would stay in the country for long, rather than FPI flows, that are basically hot money that will come in and go out. Also, when these sectors are sort of revived and are operating close to full potentials, then we'll be able to export more products, particularly in terms of agricultural products, mineral resources and all. By the time we begin to export these products, we're also able to generate more FX flows, and diversify our FX earnings base away from just crude oil. So if it's a two-way, it should have a positive two-way impact, in that light, basically. But a lot of the work is still left for the federal government to do in terms of implementing policies and ensuring policy stability, because we've seen a lot of policy backflips also. An administration comes in with one policy, or even the same administration implements a policy this year, and 2-3 years down the line, they reverse it and then decide to do something else. So these are things that would not speak well to foreign investors or even private investors within the local space or within the domestic markets there. So we think a lot of work still needs to be done by the government in terms of policy framework around the business environment.
Okay, now we've seen efforts also by the central bank. Let's go back and touch on that. Central bank in the forex market, to stabilize exchange rates and low foreign inflows into the country. But some analysts have the view that some of the CBN policies which discourage foreign investors might or could. Do you share the same sentiments? I thought about some of them. We have the Naira for dollar scheme. We have adopting the R&E window, and also the restriction of FX on some goods and services maybe that can be produced in this country, though some of them we cannot meet up with the kind of demand that we have. But all of this has been happening just to try to ration the forex available. What do you make of this, Ayo?
Okay, for us, first, picking the policies that you mentioned, first, the first one regarding the Naira for dollar scheme, it's an impressive one, really, from the CBN to sort of galvanize, dollar inflows via remittances to come through official sources, basically, because a lot of remittances into the Nigerian economy don't go through official sources, which means, they don't come into the external reserves, and CBN does not have account. The CBN is unable to account for most of these inflows. So, and the remittance market in Nigeria is a $20 billion market. That's about 2/3 of our current external reserves, basically. So, what the CBN is trying to do is to try to ensure they are able to at least get a decent portion of this market, so that would be an important an important source of FX for them, other than crude oil, which would sort of be a quick win. Is expected to be a quick win source for them, but it has proven otherwise so far since the policy has been announced, largely due to a number of other, logistical or systemic bottlenecks, basically. That's on that front. The second one regarding recognizing the iron window as the official exchange rate, I think is something that has been, long due. The iron window is still the fairest market for FX in the country. If you're going to speak to the fact that which market sort of represents the value of the naira, basically, we think the iron window does that. So recognizing the iron window, the NAFEX rate as the official exchange rate for the Nigerian economy is something that is welcome. However, the main policy, which has been the bone of contention in the analyst community, is the fact that FX rationing by the CBN, rather, we think it does more damage to FX than to the exchange rates than the goods that they wanted to do, basically. Because the impact of this is, if, for example, as a maize, for me as a manufacturer that uses maize to produce my products, for example, maybe I produce animal feeds, for example, it means the CBN would no longer supply dollars for me to import maize from outside Nigeria to do my production. So if the CBN would not allow me to access dollars at the iron window to meet my inventory needs, then my demand will be shifted to an alternative market, which is where we have the parallel market. So that explains the fact that FX rationing simply shifts a lot of demand from the official market to the parallel market, and that means if you are shifting more demand to the parallel market, to a market that is not very liquid, what you would have is a spike in the price. So that's why you would see the widening margin or the widening spread between the official exchange rate and the parallel market rate. So the FX rationing policy is something that we think the CBN still needs to look into. FX rationing on commodities should only come when we have adequate domestic capacity to produce these products. As long as we don't have adequate domestic capacity to produce these products, then we think that the CBN should not be rationing FX towards these items, because they are very important for production and for some of the goods that we consume locally. So that's the main policy issue that the CBN probably needs to revisit and relax those restrictions on some of those key products until we can achieve local capacity in producing those items.
Very, very importantly, let's wrap up on this note. I want to ask you if you think that Nigeria is ready or prepared for another shock like the COVID-19 pandemic and the long-term supply shocks and disruptions faced. And what lessons do you think will be the biggest, and what mistakes do you think we need to also notify or identify?
Okay. So clearly, the Nigerian economy is never prepared for any external shocks. Recall in 2015-2016, we had the oil glut, and that simply led to the fact that crude oil prices crashed. And we had some issues, with some of the oil installations in the Niger Delta region, which affected our oil production, and the economy went into a recession. Inflation skyrocketed, unemployment rates jumped. Fast forward about 5 years later, we had the COVID outbreak, which impacted oil production, which impacted oil demand, and consequently meant there was little demand for oil, so we had to cut down our production, and at the same time, crude oil prices also crashed. A similar narrative to what happened 5 years ago. If in another 2 years, we are yet to significantly diversify our economy away from crude oil, particularly in terms of the impact it has on our foreign reserves, because the major bone of contention is usually the impact on exchange rates, because we import a lot of items that we consume. So if anything happens to crude oil price or crude oil production, it means we don't get as much FX as we typically would get, and it means the exchange rates will probably have to be devalued for that, and it means imported items become more expensive. Nigerians are unable to become poorer because income remains stagnant and prices are going up. So when you look at all these factors, we are still very much susceptible to any external shocks that may happen in the nearest future. from a fiscal point of view, the government is not sturdy enough to withstand any external shocks. Like I mentioned earlier, total revenue that the federal government generated between January and May was about 1.8 trillion, and they spent virtually the entire 1.8 trillion servicing debts. So it means for them to do their recurrent expenditures, such as paying salaries, they have to make borrowings for them to be able to pay salaries, for them to be able to also do some of the capital expenditure that they need to do. So clearly, all is not well with the economy fundamentally. Yes, we are gradually recovering from the recession, but we are very, very much susceptible to any external shocks that could happen, particularly in the crude oil market. So we need to diversify the economy away from that, improve the business environment to ensure that we're able to attract adequate investments, even in times of economic shocks. And until we are able to get all those right, we will definitely still remain very much susceptible to any external shocks that may happen in the global economy.
Mr. Ayomide Akinloye, research analyst, investment research analyst at United Capital PLC. Thank you very much for your time on the show.
Thank you for having me, Tolo. Always a pleasure.
All right, then enjoy the rest of your day.